When this event happens, it is going to be a global crisis, the magnitude of which we have never seen. This is going to drive gold and silver, the main safe haven assets, astronomical, and you're going to see that at the end of this video. Now, I've shown this a bazillion times. This is base currency in the United States. 1794 was when the very first U.S. silver dollar was minted. So the first dollar came into existence, which was base currency, real currency that circulated in 1794, and it took 214 years to go from $1 in existence to $0.8 trillion. And then in just the next 5 years, they went from 0.8 to about $4.2 trillion. And now this is shrinking. And I'm going to show you that I know you've seen this before, but I've got some new insights that you're going to want to see. You've seen this before too. This is the stock market, the value of the stock market, the Wilshire 5000 Total Full Market Cap Index. So it's the value of the stock market. And then this is base currency. And what I've done here that's different than the other times is I've created indexes out of them. And I've indexed them right here during the financial crisis. So they're both indexed to 100. And then 200 is double, 300 is triple, 400 is quadruple. And so what you see is from this point, when base currency doubled, so did the stock market, pretty much exactly. And so here it's up about 1.8 times, and so is the stock market. And then the training wheels came off, and what's happening here is this is the pros getting back into the stock market. The brokerage houses, with their own, like Merrill Lynch and Goldman Sachs and stuff, those traders, they're in this thing. And then because this has been going on now for, this was 2009 when this started. So this has been going on for a full decade, and then retail investors, all the people with their IRAs and stuff, they jump back in. They may have let whatever they had in their IRA ride through most of this, but now they've had so many gains, they start piling in. The retail investors come in late. The retail investors tend not to be, though, they're not the smart money. They're the dumb money, and they get in the top. This is a chart that you haven't seen before. And it's the same chart of base money, base currency. The Fed calls it money. That's the red area. And in front of that, I've put this green area of currency in circulation. So this is the currency that the public has. And so where is all this other excess base currency? Well, that is excess reserves of depository institutions. How does the Federal Reserve, when they create currency, how do they get it into the economy? They buy something. They create a $100 bill, or if it's reserves that are on deposit at the Federal Reserve, they just type it into their computer, and it doesn't cost them anything. But when they create a $100 bill, it costs a little bit over 14 cents. So somebody is making a $99.86 profit on every $100 bill created, and then they go and they buy something. So the Federal Reserve gets to create basically counterfeit currency into existence and buy something. Nobody worked for this currency. And what they buy, though, for the Federal Reserve's, before the crisis of 2008, they would buy treasury bonds, was the vast, vast majority. It was far more than 90% of all of their purchases. But since the crisis of 2008, it's a mixture of mostly treasury bonds and mortgage-backed securities, and then a little bit of other stuff. They bailed out General Motors and a few other things, AIG. So they had a mix of assets, they call them, on their balance sheet. But when they create this currency, all of this is held at depository institutions. So this is in the big, who are those depository institutions? Well, Who has treasury bonds and mortgage-backed securities? Well, that's the big investment banks. That's Goldman Sachs, Merrill Lynch, and that type of bank. And so they take those assets off of their balance sheet and they become an asset of the Federal Reserve, and they give cash. They gave $2.7 trillion to these big brokerage houses. Now, what do those brokerage houses do with it? I mean, those brokerage houses, their business is stocks and bonds. And so they show up at the next treasury auction, they buy more treasuries, and they do their own trading. And so that flows into the stock market. And so this, again, is a picture of that same chart it's all indexed here to 100. And so all of that $2.7 trillion that went into the brokerage houses went into the stock markets at this point, and it's almost an exact correlation. So when I've been saying that to me, there's just no chance that this is a coincidence. This is a bought and paid for stock market rally, and then the training wheels came off, and all of the suckers have been getting in, and the smart money has been getting out and transferring the risk to the small investor. Now, I've included another line here, and that's tax revenues for the current tax receipts for the federal government. And I've gone over the financialization of government, I call it. I discovered this when I was updating my book, Guide to Investing in Gold and Silver, back in 2015. And I labeled it The Financialization of Government, the Dangerous Fog, F-O-G. And this, between these two, all of this currency creation and this, there was no correlation between tax receipts and the stock market until this century. This is very dangerous. We are in totally uncharted territory. This stuff has never happened before. In the United States, the world's largest economy, we've never created currency before like this and transferred wealth from Main Street to Wall Street on this scale. It's never happened before, and we've never had a bought and paid for economic expansion. The recession, the economic contraction was over with in late 2009. This whole expansion is phony, it's bought and paid for, and now we've gotten into this thing where when the stock market crashes, the government is entirely reliant on the stock market doing well for its own survival. If the stock market crashes and they don't do anything, if the Fed doesn't come to the rescue, then the deficits just explode. This is where the deficits exploded up to above $1 trillion. Well, guess what, folks? We have deficits coming up in the next big crash, the next recession, that are going to be multi-trillion-dollar deficits, and that is what is going to scare people all around the world into the precious metals. They're going to be seeking these safe haven assets. And, I mean, you're not convinced of it yet, but wait until you get toward the end of this presentation. This is the interest rates and the base currency, again, going all the way back to 1918. But the thing about this, I'm going to go back to this chart here. This drop right here, each time the Fed did QE1 and then paused it, this is currency leaking into circulation. QE2 and paused it. This is currency leaking into the public's hands. The banks create loans against these excess reserves, and they're no longer excess when there's loans and deposits against it. And this is leaking, but this is the Fed trying to normalize its balance sheet. So we've gone from 2.7 to $1.7 trillion. There's $1 trillion less in excess reserves since late 2014. This is huge. So this is the Fed trying to normalize their balance sheet. What they're trying to do is to get these two, if you drew a line from here and you draw this currency in circulation, they're trying to get this to meet somewhere at about 2 trillion or 2.2 trillion, something like that. They're trying to get these things to get to this normal area where there's just a little bit of excess reserves. This warped the economy. This is what created the bubble. They're trying to get this to normalize, but to do that, when they do that, they're selling off Federal Reserve assets, and they take this currency back when they sell a mortgage-backed security or a bond back to that same brokerage house that they bought it from. They're pulling cash off of the brokerage house's balance sheet, and they're taking that cash and it goes back into the Federal Reserve's account, and it vanishes. It gets destroyed. So that's the reason that this portion of the base currency has fallen, is it's gone back into the Federal Reserve's account where it vanishes. But when they sell that bond and mortgage-backed security back to the brokerage house, now the brokerage house has a glut. This is the market. They're selling it back into the market. And it's got a glut of bonds and mortgage-backed securities. And so what happens to the price of them? Well, eventually it's got to fall because there's greater supply than demand. And so they're trying to sell these, and we're about to go in to another recession / market crash while they're trying to normalize their balance sheet. What we have in our future very shortly is a whole lot more quantitative easing, because they can't let tax revenues drop, and they can't cause a further market crash by selling assets back to the banks and brokerage houses. So this is extremely deflationary for the stock market. But then I've got interest rates on here, and there's a couple of things that I want to point out. First of all, what happens when you're giving away free currency? Here we've got interest rates pretty much down towards zero. Now, this is a daily chart of interest rates. Most people don't show a daily chart. Most people don't know that there was a day in 1980 that the federal funds rate, the rate at which banks loan to each other, went all the way to 22.36%. Usually when you see this chart, it stops somewhere at around 16%. If it's a weekly, it might go up to 18%, but on a daily, there was a day 22.36%, and there was a day in 1980 where it hit exactly 20%. But back in the mid-50s and late 50s, there were a couple of days where the Fed funds rate was as low as 0.13%, and there was a day in 2013 where it was as low as 0.04%, 0.04%. It's called 4 basis points, which is crazy. This is insane, and this is a total manipulation by the Federal Reserve. Free markets do not exist in the United States because they manipulate both the quantity of currency and the cost of that currency, the interest rate, and currency is half of every transaction. But what you see here is they take it down so low that they lay the foundation for both an economic expansion but also bubbles. When they take it down too low, they warp the economy and cause bubbles to happen, and then the economy starts to heat up, and they raise rates until they pop the bubble and then dramatically lower them in reaction to that popping of the bubble and the recession that it brings on. And then they repeat the process, lower them too low, get people and businesses to go out and borrow currency, and this process just repeats and repeats. The Fed creates the bubbles and pops the bubbles. This is Alan Greenspan's response to the NASDAQ crash of 2000, take the rates down way too low, accidentally create a real estate bubble, raise rates until he pops that bubble, and then in response to the next recession, Ben Bernanke took them down to zero and created all of this currency. These things have never happened before in the United States. We're in completely uncharted territory. That is why the reaction to this is going to be something that we have never seen before. Now, we know that this is deflationary for the stock markets. What happens when you start raising interest rates like this, especially really late in this cycle? Do you see any other time during this period that the Fed funds rate even existed? Because this is all the data that the Federal Reserve has on the Fed funds rate. There is no portion where it just hangs out at zero for all these years. And then they're trying to raise this So this warped the economy and caused the bubbles that we're in. The everything bubble is this and all of this. That's what caused it. Now, raising these rates, what's really sensitive to interest rates? Well, one, real estate. If you're buying a new house, that means that your amount of payment that you can afford is greatly affected by interest rates. The higher the interest rate, the lower the payment that you can afford, so the less likely you are to be able to afford a new house. So as they raise this, that pops the real estate bubble that we're in. But there's another thing that happens. When you're giving away free currency, and that's what this is, corporate debt rises. Corporations can create bonds, and when interest rates are low, the amount that for corporations to borrow currency from private investors and if they go to banks and borrow currency, the interest rates are very low. But that debt has to roll over every once in a while. And so when a bond matures and they've got to pay off that bond, they fund that by issuing another bond. But now they've got to issue it at a higher interest rate. So this traps corporations backwards. And if we go into a recession, that means their profits are either lower or they vanish entirely. And they have to come up with the funds to pay off those bonds when they mature or those loans when they're due to the bank. And they do that by rolling it over into a new loan at a higher rate. And so that extra interest makes the payments much greater and traps them backwards in debt. And we're going to get to that a lot later. I'm going to show you some charts on that. So the world's central banks have all gone crazy. What I've done here is I've put this on an index. And from January, these are all indexed to January of 2008 at 100. And 200 is double. 300 is triple, 400 is quadruple, 500 is quintuple. And so the Federal Reserve quintupled the currency supply in just 5 years. Remember, it took 214 years to get here from $1 in existence to 0.8 trillion. And then they quintupled it in just 5 years. And the Bank of Japan has quintupled their currency supply since then. The ECB, the European Central Bank, is 3.5 times. This is assets of all commercial banks. So this is not the Federal Reserve. This is commercial banks, and this is their liabilities. This is the reserves to pay out against the liabilities. Now, on banks, on their balance sheet, the liabilities are deposits. So this is the deposits of the banks. This is all the loans and other assets like bonds, but mostly loans that they have created. And this is the reserves that they have to pay out against the deposits. So they don't have a whole hell of a lot of reserves to pay out against these deposits, and their assets are just loans, and loans can go bad. So these assets can vanish, and then they're left with all of the liabilities. And so when that happens, the Federal Reserve is going to come to the rescue. So QE4 and 5 and 6 are not very far off. This chart shows GDP, and it's U.S. household net worth versus nominal GDP. So this is the size of the economy, and when the household net worth runs ahead of that, this is paper wealth. It's not true wealth. They didn't cash out of the stock market. It just runs ahead of it. Then the stock market crashed. It got closer to it. That's the crash of the NASDAQ. The real estate bubble, a bunch of paper wealth, and then real estate crashed, and then the everything bubble that we're in. So this is about this. This is all Federal Reserve manufactured. It's an illusion. And this is the stock market after the training wheels came off. But this everything bubble, because this was all bought and paid for by the Federal Reserve, this crash is going to be worse than anything that we've ever experienced. This is the total assets of all commercial banks versus GDP. So, and this is on a logarithmic chart. The space from 400 to 800 is the same as the space from 800 to 1600. So instead of going 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, this chart goes 1, 2, 4, 8, 16, 32, 64, 128, and so on. So the percentage change from here to here is 100%. If that's 1 inch, then the next inch is also 100% increase from 800, which is 1600, and the next inch would be a 100% increase from 1600 to 3200, and so on and so forth. So this is a measurement of the percent change. So this gives you an idea of how much of the economy the banks own. And right now, commercial banks, corporations, and individuals, people, have taken out loans, so the banks have a lien against a certain percentage of the entire economy. And here, it's almost half, from 4,000 to 8,000. This is billions, so it's actually $4 trillion to $8 trillion of the economy back in the 90s. But look at how this pinches together. So the banks are owning a greater and greater percentage of the economy. And a lot of this changed back in the year 2000 with a bunch of changes in banking law. It's because we have two different sets of laws and morality in the world. There's one set of laws and morality for the banks and another set for the rest of us. Now, we're going to take these two lines and we're going to divide them into each other and see what percentage of the economy the banks actually own. And it was fairly stable when it was between 50 and 55%. And then since the year 2000, when we changed banking law, this has taken off like a rocket. And the banks, for a little while, basically owned 85% of the economy. It's crashed down to about 82. This is sort of a bad sign. That says to me that we're probably going into the next recession, or we're already in it. There's going to be several recession indicators in this presentation. This is the federal government current expenditures and federal government current tax receipts. So these are the taxes. Now, the total income of the federal government is a little bit higher than this. Each one of these peaks would be a little bit higher because tax receipts isn't the only income source of the federal government. There's tariffs and duties and a few other things that add to the income. And then there are also off-balance sheet items, though, that don't show up in current expenditures. There's a bunch of hidden stuff that they use. So the current expenditures are actually higher than this, but so are tax receipts. Anyway, can charts lie? Sure they can. This is a numerical chart, a linear chart that goes 1, 2, 3, 4. If you take this same chart and you make it logarithmic, it looks like this. So data can be manipulated, and you got to sort of watch for this. Now, I would like to present most of my charts in logarithmic fashion so that you can see the percentage change and the rate of growth, because what you see here is a slowing in the rate of growth of the expenditures, the tax receipts, the GDP of the economy. But what I run into is when I'm generating charts on the Federal Reserve's website, their chart tool that creates all of these charts has trouble with a lot of logarithmic charts. The scales will get very screwed up. Sometimes it'll crash and you lose the chart after putting half an hour's worth of work of generating the chart into it. There's a whole bunch of problems with the logarithmic charts. So to be able to put together a presentation in a reasonable amount of time, I have to stick largely with linear charts instead of logarithmic. Sorry about that. Now, I'm going to go into the probability of recessions here. Whenever you see a black background frame, this came from a presentation I did that called Early Warning, and it was released last summer in the middle of 2018. And so the data in it is 7 or 8 or 9 months old, all of the data sets, but it's still very pertinent, and you're only going to see about 5% of early warning, and it is actually anybody that wants to see early warning, it's still available. It was something that it took me a couple of months of work to put together early warning. And it's more than 3 hours. The presentation is more than 3 hours long of what is happening in the economy, what the probable outcomes are, and what I've been doing to protect myself. Now, this is all of the economic expansions in the United States, and this goes all the way back to before the Civil War. 1854 is the first economic expansion that's listed here, and the average of all of the expansions from back before the Civil War is 4.5 years. This is the Congressional Budget Office. So the Congress setting the budget of the United States, and Congress has projected that this economic expansion that we're currently in is going to run 20 years. The longest one in history was exactly 10 years, 120 months, and that was from 91 to 2001. And the one we're in is right about here, and in just a few months, we're going to overtake this if we don't go into a recession or if we're not already in one. But they have projected that this is going to go out until 2028. So this economic expansion with no interruptions. And the problem with that is they plan all of their budgeting, their spending, and they always spend more than they budget for. That's what the budget deficit is when they target so much expenditures and then they actually spend more than they planned. And so when they project out into the future at some constant rate of growth, what happens if they never plan on there being the possibility of some pullback and tax revenues falling, budget deficits explode then because it's something that they didn't give any likelihood of happening to. And so this is danger. I call it the Congressional Bozo's Office because it's insane to project out that this economic expansion is just going to go on practically forever. They're going to just party and spend like drunken sailors during this whole time without any insurance policy against some economic disaster. Now, if we take the current expenditures divided by the tax receipts, what you get is the percent that we spend above or below our income. And here, back in the 50s, you see a couple of surpluses. But then it rises and we're spending 1.5 times our income of tax receipts. Remember, there are some other sources of income. And then 2 times the tax receipts. And by the time we get up here to the crisis of 2008, the global financial crisis, we were spending more than 3 times tax receipts because they want to do deficit spending and stimulate the economy. But since the year 2000, tax receipts also fall with the stock market crashes. But one of the things I want to point out here is this is also an indicator of recessions. This rises sometimes just before recessions, but it rises during recessions, almost always. Here it rose during the recession and continued rising after the recession, but it's rising during a recession, before and during, after. During the recession, and then a little pullback, and it keeps on rising. During the recession, a little pullback, and it keeps on rising. And here, it's rising, and we've had a little pullback. It could be, a recession is a lagging indicator. It takes 2 consecutive quarters of economic contraction, but to measure economic contraction, the Federal Reserve has to wait for a month or 2 to collect the data, and it's got to be 2 consecutive quarters. So you're talking 8-9 months before they say, 9 months ago, a recession started. That's how we learn when a recession starts, is quite a few months after it actually started. Now I'm going to go to some other recession indicators. Civilian unemployment rate. When I did early warning, this was just below 4%, and now we're down at 3.8 or 3.7%. So this was just approaching this minimum here. And the mainstream news media and financial commentators when the Federal Reserve announces unemployment fell again, we've done such a great job. Well, the lower this falls, the more likely we are to experience a recession. Take a look at this going all the way back. It falls down to some very low value, and then it jumps way up. This falling down to a low value is an indicator that a recession is imminent. Back in the 70s, it took 5%, and here it's almost 6% before the next recession starts, the 70s and the 80s. We haven't seen a value this low. You have to go back to the late 60s and into the 50s to see a value as low as what we've experienced just lately. I mean, this data just came out, I think, just a few weeks ago. So this is updated very recently. But it says that we've reached an area that says if we aren't in a recession already, there is one right around the corner. And the thing is, this next recession is going to, all the manipulation that the Federal Reserve did, that's going to come back to haunt us in the next recession is going to be a crisis. Now I'm going to prove to you that Keynesian economics doesn't work. And this is the discount rate for the Bank of Japan. So it's similar to the Fed funds rate that you saw earlier, but this is for Japan. And one thing that I find interesting here is the Federal Reserve, if you do charting on the Federal Reserve, it'll automatically put these shaded bars of recessions, but these aren't Japanese recessions. These are the U.S. recessions. And this was very enlightening. This goes back into the 50s. And if you go back in the 40s, our economies were not connected. They started to become connected in the 50s, and they got very connected in the 60s and the 70s because we were by far Japan's largest market. And when we experience a recession, shortly thereafter, Japan experiences a recession, and then they react to it by cutting interest rates. If you recall, the federal funds rate, when a recession would start, the Federal Reserve would instantly cut rates. The moment that recession starts, you'd see rates start to fall. Here, what you see is we have a recession, and then sometime shortly after that, Japan cuts interest rates. So this is their recession delayed just a little bit because all of the corporate income falls because during our recession, we don't purchase as many goods from them. So their economy then suffers. And you see this delay of them starting their rate cuts. But just like in the United States, they continue the rate cuts until they stimulate the economy and they start an economic boom, but they lay the foundation of the next bubble. And then the economy starts to overheat, and they start the next rate cuts. So this is their recession right after our recession. They start the next rate cuts, and their economy starts to overheat, and then they start raising rates when the economy overheats, and they pop their next bubble. But this is all in response to this little bit of time delay from our recessions. It's very, very interesting that these rate cuts, with the exception of the Ronald Reagan double dip recession here that we had back in the 80s, they had a recession that appears to, it was just one recession that was in response to this recession, the first recession that we had during the Reagan era. And they kept on cutting rates until they got their economy to boom, but they made a big mistake. That comes in a couple of frames here. But they lowered interest rates all the way down to 0.1% here. I'm going to show you here, Keynesian economics does not work. I'm going to add one more line. Now, the reason this chart jumps so much is because I'm going to add a bunch of a legend to the right side of the graph, and so the chart becomes compressed, and I'm going to add one more line. As I add lines to this, it becomes more and more difficult to read, but I'm doing it in stages so that it makes it easy on you. You can read this easily. Now, we know that the Bank of Japan quintupled. They made their currency supply of base currency 5 times larger than it was when the crisis of '08 began. And what did they do with that? This is interesting. They've got interest rates down here close to zero. This is 1% up here. So I believe this is 1/3%. They did this in a very short time period, and they're still doing it. It's still got this northern trajectory where they're creating currency. What did they do with most of that currency? And this next frame is the frame that proves that Keynesian economics doesn't work. I'm going to add one more data set to this. This is the interest rate, the currency creation, and the Nikkei 225 index. This is the 225 largest publicly traded companies in Japan, and I've scaled this so that it uses up most of the area on this graph, but there is no legend for it, so there's no scale that you can see. But I believe it topped out at about 38,000 or 39,000. It was just a whisker away from 40,000 points. But what you see here is this recession that we had, and then the following response, the recession in Japan that happened, they cut rates dramatically, and then right about here, when they got down to 5.5%, they started creating an enormous stock market bubble, and this thing took off like a rocket, just totally insane. And look at what happens when they get down to like 2.5%. So they've gone from 9% down to just 2.5%. Now that's almost free currency. And the stock market took off like a rocket and created a bubble economy. And this time period right across here is when the Japanese were going around the world and buying up all of the world's finest assets. They bought Rockefeller Center. They bought all the tallest buildings in Chicago and Los Angeles. I used to live in Los Angeles near MGM Studios. When I was a kid, I used to sneak into the backlots of MGM Studios and play when I was a little kid. I see an old movie and I go, I've been in that house. That's just a fake house front. You go walk in the front door, there's nothing behind it. I used to, when I was a teenager, there was a hole in the fence that butted up to the fields where Standard Oil had all of these oil pumps and oil derricks going on, and we used to ride motorcycles out there. And I'd go in during the daytime and ride my motorcycle through the lot, and security would chase me. I mean, we would terrorize. It was fun. We were kids. We were probably interrupting some movie because of the sound of our motorcycles. It's interesting. I watch an old Twilight Zone today, and in the background, I can see the Standard Oil fields where I used to ride. But they bought what was MGM Studios. It's now Sony Studios. It was Sony Studios, and then it became Turner. Ted Turner bought it, and it was Turner Studios for a little while. He sold it to another company, and then Sony bought it in this time frame. It was said that the little tiny island that the Imperial Palace is on in the center of Tokyo was worth more than the value of that land was worth more than the entire state of California during this time period. But because their central bank had created this enormous bubble, when that bubble popped, and then through Keynesian economics, they come in and they create currency to prop up the banking system, to prop up companies that should have failed. They went into what's called a zombified economy. I've got friends that live in Japan, and this area here where their stock market is still half of what it was back in 1989. So it's approaching 30 years here, 3 decades of a lost zombified economy that Japan is stuck in, grinding sideways, and they can't get out of it because they never let the free market clear. They didn't allow the bankruptcies to happen, and their recession could have turned into a short-lived depression, but they would have come out of it with a healthy, clean economy and healthy companies that could compete in the free market and serve their population much better than they're serving them today. They've got what's called a zombified economy. And when I talk with people in Japan, they say, oh yeah, the economy's lousy and it's been lousy for so long. Well, this currency creation, where did it go? The Bank of Japan actually creates currency, and they go into the stock market and they purchase stocks. More than half of the Nikkei 225, the 225 largest companies in Japan, publicly traded companies, are now owned by the Bank of Japan. So they've been buying up stocks, trying to get the stock market going, and they're even failing at that. The stock market is falling one more time, and this crash that we're going to experience is going to be global. And so I would expect that this is going to go back down into this area again, and all of this currency creation and them buying up half of the stock market, which is so immoral. I mean, this is just wrong. They're bidding away assets from private investors to try and prop up the stock market and fool people into thinking the economy is good so that they'll go out and spend, and it doesn't work. And they've done this with interest rates down at 1/3 of 1%, and it's still failing. And the problem is, if you talk to any of these Keynesian economists that are running things, what they're going to tell you is that, it isn't our theories that are wrong, and it isn't our models that are broken. Those have to be correct. Those theories absolutely have to be correct. They're right. What's wrong is that we didn't do enough of it. Baloney. Look at what they've done. They've tried to manipulate the economy. It doesn't work. The free market always wins in the end, but the free market punishes all of these manipulations. And the punishment this time is going to be horrific because the same thing is going on all over the world, as you saw in that chart earlier that also had the European Central Bank in it, the currency creation growth. So what is happening in Japan? Why are they trapped in this thing? There was an economist named Richard Koo that called this a balance sheet recession. If you do a search, or we'll post a link for some videos of Stephen Keen. Steve Keen is an Australian economist that has put together some models that are really fascinating, and it shows when you build up too much private debt, once you have that final crash, you go into a zombified economy, and then you have to deleverage. Well, this chart was generated on the Federal Reserve's website, and the data does not go back to 1989 when they were in the bubble. It goes back to the end of 1997. But what it shows you is this downward trend of the total debt of corporations in Japan, and this is measured in dollars. So this is because the currency supplies keep on getting expanded and inflation raises the price of everything, this downward trajectory is even greater than what it looks here, because this is nominal, not as a percentage of the economy. If you looked at this as a percentage of the economy, it would be a far greater reduction, not from 1.2 trillion down to 700 billion here. It would be a much greater reduction. Now, back to the United States and back to the everything bubble. Whenever you see these black frames again, I'm sorry we're jumping back and forth from white backgrounds to black backgrounds. I didn't have the time to put all of this into some fancy presentation. That would have taken another week to do. We've got to download data and generate our own charts to get this real slick look. But this is the GDP of the United States, so that's the size of the economy, and then this is the value of the stock market, Wilshire 5000 Total Market Cap Index. And the stock market has no business being larger than the economy. When it is, you're in a bubble. This was the NASDAQ bubble. This is the peak of the stock market during the real estate bubble. We're not measuring real estate here, so this is only half of the economic bubble that was going on. This was a stock market crash. This is a stock market and real estate crash. And now we've got the everything bubble, and this data only goes to the end of the first quarter of 2018, because this was released in the summer of 2018. It's still very pertinent today, But by the beginning of the crash that we're experiencing, the markets peaked in October. And so if you ran this data out to October, this was probably way up here somewhere. So it's gone way ahead of the GDP. Now, if you divide these two, what you get is the Buffett indicator. And this is a measurement of how big the stock market is compared to the size of the economy. And what you see here is that when the stock market is between roughly 50 to 65% of the economy, things are in balance and everything is okay. But once it runs past that 55%, stocks are overvalued. But then when it goes up toward 90, 100%, now you're in bubble territory. Goes over 120%, this is hyperbubble territory. And it becomes very, very dangerous. When stocks are down under 50%, this was the time to buy stocks. You would have experienced that entire bull market run-up of the 80s, one of the greatest bull markets in history. If you buy in up here, anytime that it's overvalued instead of selling, you just get to ride through all of these dips and crashes that we've had. By the time this next crash is over with, it's going to take many years to get back up to the same level that the stock markets hit in the year 2000. So this is going to be 30 years, a lost 3 decades is what I believe. This is going to be all of the energy of the manipulations released upon us. Now, the reason I show you the Buffett indicator is in the early warning presentation, I came up with my own indicator that I called the Market Fragility Index, and I'm going to show you very quickly how that was put together. So this is margin debt, and margin debt is the loans that brokerage houses make to traders and investors. It's basically you can buy a stock on margin, you put 20% down, and then you borrow 80% of the rest of what it's going to take to buy that stock, and now you're leveraged at 5-to-1. If the stock goes up just 10%, you make 50% on your investment. You make 5 times whatever the stock goes up. So it goes up 10%, you make 5 times. But if it goes down 10%, you lose 50% of your investment. And something about margin is that if you lose 50%, now you're leveraged at 10-to-1. And so if it goes down another 10%, you're completely wiped out on what's left. Now, why is this going up to these insane levels? Now, it's because I was opening up a trading account recently, and this is with Charles Schwab brokerage house. But when I got to this, I was absolutely shocked. I couldn't believe it. Years and years ago, when I opened my first trading account to invest and buy a bunch of mining stocks and some other things like that and go short on the stock market back in 2001, I think it was, margin was something that you'd open an account and then you would apply for margin separately. And you had to qualify. You had to state that you were an investor that was worth a certain net worth and that you have a lot of experience with margin and options and things like that, because with your margin account, you got the ability to trade options and futures, which are highly leveraged. And but now it's automatically added unless you check the no box. And here's the problem with that. People become charmed by margin. It's been since 2009 that the stock market has been rising. And so people buy stocks and then they go up and they want more stocks because they're going up, and they go up some more and they want more. And so it's hard. If you've got margin available to you, it's very difficult not to use this margin. And the thing is, to learn more about margin, we encourage you to use the educational materials available at this margin education. So you actually have to click a link to go and see what the terms and conditions are. Now, when I opened my first account, the terms and conditions were that if that margin account goes negative on you, the brokerage house has the right to foreclose on you. They can take your car, your house, your bank account. They can basically take everything you have to make themselves whole on your bad bets. They are funding, in a lot of cases, they're funding a gambling addict that's been winning because he's on this lucky streak because the markets have been going up for close to a decade. So this amateur trader is drunk on margin. So that is one of the reasons margin debt is at an all-time high. The next chart here is margin debt as a percentage of the size of the economy, the GDP. And what you see is that it's at record territory, far above where it was when the NASDAQ crashed, far above where it was when we had the global financial crisis of 2008. Now, this is dangerous because margin, if the stock market falls, an investor can get wiped out. It makes traders very nervous, and they sit there with their finger practically hovering over the sell button. In fact, on most of these trading platforms, you can configure a key so that with just pressing a combination of keys, a little message will appear that says, "Are you sure you want to liquidate everything and move to cash?" And you can say yes, and it sells everything in your portfolio, and you've moved to cash for safety. Now, that is what happened a lot in the crash in 2008, and that's the reason a lot of people that own gold also had gold futures, and they had GLD or SLV, so a lot of paper silver that exists on their trading platform, paper gold. And gold and silver went for the ride during that crash for the first couple of months, but in October, they turned around and started rising, and they rose dramatically while the rest of the stock market crashed for another 5 months. So gold and silver were definitely the place to be during the financial crisis of 2008. But during that period, in the initial stages of the crash, if you weren't panicked, you had the opportunity to buy gold at under $1,000 and silver under $10. So anybody that was operating against their fear, if they sold all the other assets and kept their paper gold and silver, which I don't believe in, they would have done very well. The people that actually owned physical gold and silver and added to their positions. I added an enormous amount to my position back in 2008 during that market crash, and in early 2009. I pretty much doubled my position in precious metals during that time period, and boy, did that pay off. So, this is margin debt divided by the stock market capitalization. So this is the Wilshire 5000 full market cap index divided by margin debt. And what you see here is that it used to average somewhere around 1% of the stock market was leveraged with margin debt. And, well, actually more than that, because you get to borrow 5 to 1. But what you see here is that as of last summer, and this probably rose a little bit into October, we were at twice that level, and it's only been exceeded one time in history, and that was during the real estate bubble just before the crisis of 2008. What you see, the crisis of 2008 was right about here, and this rises a little bit after the crisis because the markets are crashing and the margin debt is still the same. How much the traders owe their brokerage houses is still the same until they liquidate some of their assets and pay off that margin debt, which they did during the market crash. But like I said, this makes the stock markets very fragile because this is like cracks in the foundation. The Buffett indicator is a measurement of how top-heavy the stock market is. The margin debt is the measurement of the cracks in the foundation. So you've got a very top-heavy stock market. It's probably up here, like I said, with cracks in the foundation. So what I did was I took that margin debt, which varies above and below 1 and goes up to about 2. So I took the Buffett indicator times margin debt, and what I got is something I call the stock market fragility index. So this is part of, there's a much longer and more detailed explanation of all of this in the early warning seminar. But what you see here is that it's no threat back here when stocks were an extreme bargain, and it's normal in this area, and then time to worry unstable, super fragile, and then threat to the global financial system. I mean, in this area, we had extreme problems with the global economy. And we're up here at levels never before imagined. So we've got a stock market that's way overvalued, but it's highly fragile because of all the margin debt. Now I'm going to move on to real estate. And, is real estate in a bubble, and is that bubble popping? And the answers are yes and yes. In Australia, real estate has been popping for the past several months. In San Francisco here, Silicon Valley, San Francisco, this is the number of listings that have reduced their prices, and it's the percent change from a year ago. And what you see here is that there are more than 4 times as many homes that are listed that have to reduce their price before they're sold, reduce the price on the listing to get people to look at it. And so 4 times more than a year ago. Now we've got how much the average home, this is the median asking price, and it's the dollar amount change from a year ago. And currently, they're dropping them by about $100,000 on each house to get that house to sell. Why are they doing this? Well, it's because homes aren't selling. This is the increase in inventory of homes. And so it's the number of active listings, and it's the percent change from 1 year ago. And there are more than double the number of homes on the market than there were a year ago. This is all a function of supply and demand. If you've got too much supply, how do you get rid of that supply? How do you get these homes to sell? You got to drop the price. Price is what sets supply and demand in equilibrium. It's called price discovery. That's how all prices are created in the free market. Now, does that mean that the stock market and that real estate are the biggest threats here? Not necessarily. To do that, you got to look at the increase of debt in the different sectors of the economy. What we have here are households, corporations, government, and the banking sector. Now, the last crisis was mostly the banking sector, and some of it was households being foreclosed on. So you take a look at what the growth was. This is a 5-year period from 2003 to 2008. The growth of household debt was almost double. The growth of corporate debt was less than double. The growth of government debt was less than double. The growth of the financial sector was more than double. So this was the thing that got blown into the greatest bubble. And this was this thing that was blown into the second greatest bubble. And what suffered most during the crisis of 2008 was first the banking sector, the financial sector. That's where the big bailouts came. And a lot of household net worth was destroyed through foreclosures and so on. Now, since the crisis of 2008, what has grown the most? Well, it's not household debt. That's grown very little. The corporate debt has grown significantly. Government debt has doubled or possibly more. The financial sector is actually a little bit smaller. So this is suggesting, now I'm not saying that this is actually what's going to happen, but what it's suggesting is that the next big crisis comes in government bonds, so government debt and corporate sector. I've got more evidence, especially on the corporate sector. I'm not going to cover government debt in this video, but the corporate sector is in for some big problems in this next big crash. So this is all the debt that's securitized plus all of the loans in the United States. This does include government debt, so it includes the treasury bonds and so on, which is about 20 trillion of it. But the rest of the debt, this is approaching $70 trillion. This is an insane level of private debt that is going on. There's in a $20 trillion economy, we have $50 trillion of total private debt. That means if you subtract the national debt out of this. And so this is dangerous, and I encourage you to watch one of the videos by Stephen Keen that shows what happens when you build up too much private debt in an economy. Now, this is the non-financial corporate businesses. So basically, this is corporate debt, not part of the banking sector debt, their liability level, and the Fed funds rate, so interest rates. And what you see here is that corporations have been on a debt binge lately. They're like drunken sailors. And so this debt binge, getting high on debt, what did they use all of that for? They didn't use it for capital investment. They didn't invest in a lot more equipment to grow their businesses. They didn't invest in a whole lot more employees. What they invested in was stock buybacks, which drives the price of their stock up, and then the company owns more of the stock. So the company is worth more temporarily. The company also has a lot more debt. It's added all of this debt to it. Now, that's because this was free currency. The Federal Reserve was basically giving it away for free. So when the Fed takes interest rates down, corporations can also create bonds and sell them at a much lower interest rate. So the cost of servicing their debt is very low. But all of those bonds have to get rolled over. They mature someday. There's payments to be made on them, and then the principal comes due, and they have to pay off these bonds. So what they have to do is either pay it off out of the cash that they've got or roll it over by issuing another bond. Except interest rates are going up, which means the rate of corporate bonds has to go up, which means the rate of interest that they're paying back to the party that loaned them the currency, whether it's a bank or whether it's the public, retail investors buying that bond, they have to pay back at a much higher interest rate. So the cost of this debt increases in the future. The cost of this debt that they've already taken on is going to increase in the future. And there's a big recession coming up, and it's going to be bad. And so that means their profits are either less or not there at all. They may have losses, and during that time, they have to make these payments or default on them, which is basically a bankruptcy. And so that means they have to dip into assets. They have to either dip into any cash that they have on hand or sell off or finance certain assets that the company has. It's very dangerous, and they can get trapped backwards in this debt during a contraction of the economy, a recession. Now, this is pretty scary. This is corporate debt in China. And what's scary about it is this goes back to the beginning of this century, and there is a 100,000% increase. It's more than 100,000% that corporations have taken on debt. So the rate of growth here, when this event happens, it is going to be a global crisis, the magnitude of which we have never seen. It's going to be huge. This is going to drive gold and silver, the main safe haven assets, astronomical, and you're going to see that at the end of this video. Now, this chart is part of the everything bubble again. So what's our future? What's going to happen during this event? This is the S&P 1500, not the S&P 500. So this is the largest 1,500 companies in the United States. Now, when you look at the value of all of the publicly listed companies, it's heavily tilted. Most of the value of all of the corporations, the businesses in the United States, lies in maybe the 50 largest businesses that there are. So this 1,500 businesses probably represents more than 80% of all the value of all the businesses in the United States. And this is a measurement of zombie companies. What is a zombie company? That is a company that has so much corporate debt that it's unable to pay just the interest due on that debt. Never mind the principal, just the interest. It can't pay it out of what's called earnings before interest and taxes. Now, if that's the earnings, the profits, before you've paid your interest that's due and the taxes, and the interest due exceeds these profits, that means after you pay the profits, there is no profit left. But, there's going to be some sort of taxes that they still have to pay. And what you see here is that with the stock market crash of 2000, it began with this at about 3%. There were 3% of these 1,500 companies couldn't afford to pay the interest on their loans. And as the economy shrunk, a greater and greater percentage of companies in the S&P 1500 couldn't pay their debts, and it peaked here at about 9%, a little over 9%, back in 2003. Now, it was March of 2003 that the markets bottomed and turned around, and then the economy turns around a few months later, and the companies start making more and more profits as the economy gets better, and this reduced to about 5% or 5.5% of the companies. And then by 2008, it was 5 3/4 or something like that, closer to 6%. And then the crisis of 2008 hits, and the economy gets much worse, and these companies aren't making as much money as much currency, because the economy contracts. Their profits are gone. And so this rises to over 12% of the companies. This is the 1,500 largest companies in the United States. 12% of them couldn't make their payments, and they had to dip into, they had to finance some of their assets, equipment, buildings, things like that, or sell off assets just to make the interest payments, not the principal, on what they had borrowed. And then the economy started getting better after 2011, and this fell during this time period, and it fell to about 9%, about equal to this peak. But then the economy kept on getting better, and they took on all of this debt. Why did they do that? It was the free currency. It was the interest rates that the Fed artificially created. And so the Fed induced all of these corporations to take on all this extra debt, and this data ends at the end of 2017. This doesn't go into 2018. So this, by October, had exceeded 15% of the 1,500 companies in the S&P 1500. When this next crisis happens, this is the level that we're going to take off from, and it'll increase just like it did the past two times as the economy shrinks and more companies get trapped underwater in debt. It would not surprise me to see this exceed 25%, maybe even touch 33%. That's a third of all of the biggest companies in America that probably represent 80 to 90% of all the value of the companies in America. A third of them, 500 companies, trapped backwards underwater. If you don't think QE4 and QE5 are coming soon to a theater near you, you're smoking something. This is inevitable. There's going to be bailouts. There's going to be emergencies. This is going to be horrific. You're going to see a whole lot of companies getting bailed out because the companies, these corporations, drive the economy of the United States. They drive the economy of the world. And they're going to be in some very, very serious trouble sometime very soon. Now, we're going to move on to total levels of debt, the national debt. This is also from Early Warning, which took me a couple of months to put together. It's more than 3 hours long, but it's still very worth taking a look at if you want to get prepared. It also shows what I've been doing to prepare myself for what I usually say for what I believe is coming. For me, I just know this in my heart. There's something very, very dramatic coming, and it's from Haunting the Federal Reserve's website. I know this because I go on their website and I spend hours trying to figure out what are they doing and what does the future hold. I don't want to know what the mainstream media is going to tell me. I want to make up my own mind based on data. And the data says that we're in some deep trouble. So we've got total debt. This is that $70 trillion almost of total debt, which includes the national debt, which is the red area, and the purple is GDP. And these are laid in front of each other. So you've got the yellow in the background, the purple in front of that, and the red in front of that. And there's another way to express this. This is linear, and I'm going to show it to you logarithmically. And because we were putting together our own charts, every time I would try this on the Fed's website, it would crash, and I'd lose the chart. But we downloaded the data, put together our own charts. The source is all Federal Reserve data. But here you have GDP, and you've got the national debt. And after World War II, we were at about 100% of GDP. So these lines are together. And then we grew the economy much faster than we grew the national debt. And then we reversed that trend and grew the national debt much faster than the economy. And here we are back up to levels where we were at in wartime. And this is a dangerous place to start an economic contraction and a crisis with. It's very, very dangerous. And then the total levels of private debt are way too high to be starting this without going into a zombified economy. And that is where we're headed. This next crash will probably bring us some zombified economy. And the problem is, when Japan went into their zombified economy, they had us to sell stuff to. We were in the middle of an economic boom all through the 90s, going into the stock market boom. And then, through the 2000s, we had the real estate boom. So they had us to sell stuff to, yet they couldn't get out of their deflation and their grinding sideways horrible economy. So if you take the national debt and you divide the national debt into the GDP, what you get is the percentage of GDP that's represented by the national debt. You can see here during World War II, it exceeded 110%, about 115%. And we're up at levels at about 105% now. And this does not include off-balance sheet items and unfunded liabilities. If you include all of the promises that we have made, this is way up over World War II levels already. And that just says that the Federal Reserve, there's no tools left in their toolbox of manipulation. The last go-around, when the crisis of 2008 happened, they took rates down from 5.5% down to pretty much zero. So they had 5% of range. Now we only have 2.25% of range on the Fed funds rate. They may take rates negative, but the only tool that they really have left is currency creation, which they call quantitative easing to keep the public confused. The quantity that they're easing up on is the quantity of currency. So they're reducing any constraint to the quantity of currency out there, meaning print. That's what quantitative easing means. Now we're going to move on to gold and silver. In my presentation at the beginning of the year, I presented these charts of gold. It's beyond the scope of this video to define everything like I usually do. So go to that video. There were two videos at the beginning of the year, and I define the commitment of traders report. And these are the commercial traders, the big banks and so on that trade in gold and silver futures. And they've gone net short again. And when they do, usually when they're big net short, usually a price drop will follow. And so I said that there could be a buying opportunity coming up again. Gold and silver may take a little plunge in price. But what has happened is we've had the government shutdown, and so this report, they've stopped reporting it. This was the last report. We only have information going back to December 18th, I think this is. What you see in silver is energy building up because of very unusual things happening. The commercial's going net long, which never, ever happens. I mean, going back to 1986, it only happened one other time, I believe. But the very fact that we're flying blind here and we can't see this is very disturbing. We don't know if the commercials have gone net long again or if they've piled on more shorts. So I don't know if gold and silver are going to make another last pullback before the big bull market in them resumes. You know, in gold and silver, we've got a secular bull market, and we've been in a mid-cycle pullback, a correction in the precious metals. And so that's what the bear market has been since late 2011. in precious metals is just nothing. We're in this giant version of what happened in the 70s. I believe that the bottom is in. The bottom was back in late 2015, and that we're on the way up. I don't know if we're going to get this one last pullback. I have some cash set aside to buy a little bit more precious metals. Now this is, and I've covered this many, many times, and this price target keeps on changing. But if history were to repeat, and the value, this is the value of the gold at the Treasury, so it's the number of ounces times the price of gold, and this is the quantity of base currency that exists, the dollar value of all the paper dollars and deposits at the Federal Reserve that exist. And twice during the last century, the value of the gold at the Treasury has risen to meet or exceed the value of all of the base currency that exists. Here, it is the free market and the will of the public doing this, and it way overshot back in 1980. This is January of 1980. But what I show here, this spread is larger. The opportunity between this, if history were to repeat, and I believe that that is what's happening, as history is repeating, this is the bull market of the 70s. Gold went from 35 to 200 to 100 to 850. And this mid-cycle correction is what we've been in. This is just a long, protracted, drawn-out version of what has happened in the 70s. And you're going to see this go up and meet this because of the enormous amount of panic that is going to happen during this horrific crash that is the result of the Federal Reserve and the world's central banks trying to manipulate everything. The Keynesians are wrong. Keynesian economics does not work. The free market always overwhelms their manipulations, and the problem with that is the energy from warping the economy. When they push one sector or another sector into a bubble, the economy is warped. The free market tries to straighten all that out, and when it does, it punishes anybody for manipulating the economy, and I really do think you're going to see something horrific. Now, one of the other things I measured, this was one of the premises of my book, Guide to Investing in Gold and Silver. Since credit cards were created, back here, Diners Club was the first one in the late 50s, and then American Express. Credit currency is very similar to base currency. It comes into existence, though, when you make a charge on the credit card, but the merchant that you're paying, their bank account can't tell the difference between cash or the credit currency that you created when you made that charge that's in circulation, and it stays in circulation until somebody saves it up and pays down credit card debt. So you have to add that to the currency supply. And if you do, if history were to repeat and the value of the gold at the Treasury rises, so it's the number of ounces they've got, which is now static, times the price, here it's the ounces that are changing, and the price is static. It was $20.67 an ounce. And then the price went to $35 an ounce. And this is the number of ounces changing. Then the number of ounces becomes static, and it's the price of gold changing that causes the value of the gold at the Treasury to rise. And for it to rise to cover the currency supply plus outstanding revolving credit like it did in 1980, that requires $18,000 per ounce gold today. This is a moving target. I'm not guaranteeing it. But what I can tell you is that there's going to come, just like in 1980, when gold hit $400 an ounce in November of 1979, in 1971 it was $35 an ounce. So just 8 years earlier. And investors thought that $400 was a ridiculous price for gold. And so when they'd go in to buy gold at some coin shop or something, and back then the average person didn't make very much. So you're making $15,000 a year. You've got $1,000 in your bank account. You draw out $500, and you go into a coin shop and you say, "I want to buy gold," and they drop one coin in your hand. But the reaction was, well, how much is the silver? Well, you can get 35 of those or 50 of those for the same price. And that's when the public says, well, I want the silver. And that's when things turn around for silver, and silver takes off like a rocket. So that is probably going to happen at around $5,000 per ounce gold, I believe. That's the point where people will say, wow, in the year 2000, gold was only $250 an ounce, and now it's $5,000. So I believe that $5,000 is a stupid cheap price for gold, that it is absolutely going there. And here's another way of measuring it. This is the amount of gold at the Treasury divided into the currency supply. So the amount of gold at the Treasury divided into the currency supply. When the value of gold at the Treasury exceeds the value of all the base currency, then gold is expensive. When the value of gold at the Treasury is less than base currency, then gold is cheap. And when it's down here, it's very, very cheap. And here's the data. And you see, this was actually unpegging gold for a day and then repegging it. We were on a gold standard. So they'd unpeg it from the US dollar and then repeg it. And over a month and a half, exchange rates changed. So it's really the free market revaluing gold. Went up to $35 an ounce, and it matched the size of the currency supply. And then it exceeded the currency supply for a while. And then this is 1980. And right now, gold is on sale. It's like almost the cheapest it has ever been. And John Williams at Shadow Stats agrees. When you use the Ronald Reagan, the pre-1980 Consumer Price Index, you use that method of calculating inflation, and you inflation adjust gold, it's at a 300-year low right now. So this is information from John Williams at shadowstats.com, Shadow Government Statistics. Now, the last chart in this whole presentation, I haven't talked about silver much because gold is an economic indicator. And this whole presentation has been about the economy. Silver is not an economic indicator until people start rushing back into silver. Gold always has some monetary demand. Right now, silver has no monetary demand, but it's going to get monetary demand. The world's central banks hold gold as an asset, and they've been increasing their gold holdings pretty dramatically, especially countries like China and Russia, where they know something is coming and they're getting ready for it. But silver doesn't have any monetary demand yet, except for a few investors that are trying to protect themselves and they believe in silver, but it's a very small amount. So this is the sources of mine production, and only 30% of all the silver produced comes from silver producers. The rest is just a byproduct of all these. Now, in a global financial crisis, you're not going to have much copper dug up because the real estate booms that have been going on all over the planet, they're not going to be needing more copper plumbing and more copper wire. And so the amount of production of copper is going to drop dramatically, probably by more than half. Lead and zinc. These are things like car batteries and zinc castings for cars and so on. That automotive production is going to fall dramatically, and you're going to see this production go down. So you're left with about 40% of the production, and if this 60% falls by half, there's a whole lot of silver production that is going to vanish just when the public is rushing into silver. This is the end of my presentation, but I really do think that gold and silver are finally going into this last up leg. I don't want to see it, but, I can't correct this stupidity of politicians. I can't get them to do what I think is correct, what I know is correct from an Austrian economics point of view, and I can't control the world's central banks. I've often said that gold and silver come with a central bank guarantee, and the guarantee is that they will never stop printing the currency that gold and silver are measured in. So when you're printing currency that measures real money, eventually that real money has to catch up and probably exceed that currency. And that is what's going to happen over the next few years. There's going to be a crisis. You're going to see gold and silver gain many, many times in absolute purchasing power. So that's about it for this presentation. I want to thank everybody for watching. Hopefully, you all protect yourselves. You've got to make up your own mind. Nothing in here is financial advice. I'm just showing you, this is the reason that I have been protecting myself with gold and silver. Even during the pullback that we've had since 2011, I've been accumulating during all of that. I've been accumulating gold and silver since 2002. And, I was a precious metals investor before I was a precious metals dealer or before I wrote my book. I started investing in precious metals in 2002. 2005 is when I incorporated my company that sells precious metals, goldsilver.com. And it wasn't until my book came out in 2008 that actually became a viable company. So I was a precious metals investor from 2002 to 2008 before I was a serious precious metals dealer. So this is what I'm doing for myself. It's not investment advice. I'm not telling you to do it. You need to do your own research. This is only a tiny, tiny fraction of the information that is available out there about the world economy. But it shows me things that sometimes scare me and sometimes give me reason to celebrate. The reason to celebrate is because I know that governments and central banks around the world are going to do the wrong thing because they believe in economic policies that are fallacious. They're wrong. They're false. It's going to pay off big I believe, for me, the precious metals investor. Thank you very much for listening. I hope you got a lot from this, and we'll see you next time.